Right. Well, welcome everybody to tonight's stream. We're going to be talking about our all-weather strategies and global investing. You may notice I'm in a different position than I normally am because I'm not in my office. I'm in my living room. I had a problem with my computer, so I set it up over here. Mom just went to bed, and she's in the other, right behind this wall here, sleeping. Hopefully, I don't wake her up. And I'm going to be talking about what's going on in the world. One of the things that I have been thinking a lot about is world war. We are so close to a world war. It's the closest we've ever been since I've been alive. And I just hope that wiser people, that cooler heads prevail, and particularly that the U.S. starts talking with Russia and they come up with some resolution. Just something that I've been thinking about. Also, I've been doing a lot of work on competitive strategy and just finding that topic so fascinating about business. And when it comes to investing, we want to invest in companies that have a competitive strategy. All right, well, let's get on. I'm going to be sharing my screen, and I don't have two screens, so I'm going to share my screen for a little bit, and then after that, I'm going to come back on. Remember to ask questions in the chat, and then I haven't seen any messages in the chat yet, so say hi in the chat and ask any questions. I love your questions, and they can be very tough questions and direct, and I'll do my best to answer them. So let's look at the presentation. Hold on one moment. All right. So we're going to be talking about our all-weather strategies, and we're going to be reviewing the performance in July. Remember, again, ask your questions in the chat. I love questions, and I'll do my best to answer them. So our allocation strategies are global, they're long-term, and they're diversified. This is the key to what we're trying to do. We're trying to gain from long-term equity returns, but also trying to reduce the downside risk. And I just want to take a few moments to remember why we're here. Why are we here meeting today? It's to build wealth. It's to build our wealth over time, right? Remember, over the long run, it's a marathon, not a sprint. Now, I just thought we would highlight three pillars of investing. And the first one is be broadly diversified. You don't want to own one market, one sector, one asset class. You want to have a mix. Number two, contribute regularly. Without consistent contribution, you don't get the benefit, for instance, of dollar cost averaging and other benefits of just contributing. And number three is stay invested. It doesn't make sense to get your money out, then go in, then go out and go in. In fact, there was a recent study that I saw that I just mentioned, an interesting study that I saw on an academic study that came out of the US. And it basically looked at a period of time. And during that period of time, the stock market went up by 10% on average per year. And what they try to do is calculate the performance of the average individual investor. Did they capture that 10% upside? They didn't capture it. Why? Because they entered and exit at exactly the wrong times. So this is why I always stay invested. And just to say hi, Knock Noise says hi, and Siri Rod, good to see you. I just saw you. That's cool. All right, let's continue on. I'm going to share my screen. Hold on. And let's go back to the presentation. And as I said, stay invested. Now, I have 12 steps that I talk about to financial independence: creating a plan, keeping investing simple, starting early, get real about stock market returns, be realistic, do it yourself, avoid mistakes when you're young, build wealth through savings, keep financial costs low, diversify to reduce risk, and own both stocks and bonds, and trade infrequently and stay invested and watch it grow. These 12 principles come from my book, How to Start Building Your Wealth Investing in the Stock Market, and that's available in English and in Thai in Thailand. and also through the online course that I have. Now, our goal is to deliver steady returns over the long run. Our all-weather strategy, or AWS, we launched it in February 2019, and it targets a 6% average annual return. The all-weather Alpha Focus was launched in October 2021 and targets an 8% average annual return, or per annum. And all-weather Inflation Guard we launched in July of 2022, and it targets a 4% per annum return. Remember, that one is really low risk, which you can see if I just grab my pen here for a second. You can see this is meant to be low risk and very minimum volatility. So those are our goals. Now, since the inception of the all-weather Inflation Guard, so I'm going back to July of 2022 and comparing all three strategies, what we can see is moderate risk all-weather strategy has had the highest return, and highest risk Alpha Focus ranks in the middle, which we would expect the opposite. But right now, the volatility of the market has caused all-weather strategy or Alpha Focus strategy to come down. And Inflation Guard has had the lowest volatility. That's the green line. Now, we create our strategies for decades. Now, even decade is not really long term. Here's me when I was a baby, and that's me when I moved to Thailand, and that's me when I'm going to be 100. Our aim is to create strategies that perform over many decades. So the things that we're going to cover today, well, we're going to go through performance, and then we're going to look at the global outlook of what I think is happening in global markets. So first, let's look at all-weather strategy. It was up 2% in July. Alpha Focus was up 2.3, and all-weather Inflation Guard was up 0.6. So let's look at it. All-weather strategy is global, long-term, and diversified. And since inception, this strategy was up 27.5%. If we look at it, it was about 5% above a 60% equity, 40% portfolio. Here we can see in July, the strategy was up 2%, which was 0.1% above the 60-40 strategy. So a little bit of outperformance, a tiny amount. Remember, these are after fees as best as we can calculate them. And our 25% gold allocation did okay in July. And our 25% allocations to Japan and developed Europe were a drag on performance relative to world equity. Let's now look at all-weather Alpha Focus, which was up 2.3%. This one is global, opportunistic, and long-term. It's also defensive. So since inception, the strategy was down 9.9. It was a rough time. What we can see is the 60-40 portfolio has been about even with it until recently, where we've underperformed that 60-40. Again, I think long-term, so I don't worry about shorter-term underperformance. Here we can see that we're just slightly above the world equity right now, but without all the volatility of that green line in our red line. Here we can see in July, the strategy was 1.5% up, which was 0.3% below the 60-40 portfolio. The strategy was 1.5% our world equity, and out of our biggest tilts, gold was the best performer in July. Now, finally, let's look at all-weather Inflation Guard, which was up 0.6%. Now, this is a much more conservative portfolio. It's global, it's long-term, and it's definitely defensive. So since inception, the strategy was up about 1.3%. And basically, that's about a 1-year performance. And the 40-60 was up a bit more at 104% or 104, and that would be 4.2 percentage points. But this strategy has experienced less volatility. Here we can see in July, the strategy was up 0.6%, which was 0.7% below the 40-60 strategy. Our tilts to world IT and gold did best, and the world equity fund that we use in the strategy underperformed the benchmark slightly. and tips fell with lowered inflation expectations. Now, before I go to that, I'm just going to stop sharing and switch over and see if we've got any questions. I'm happy to answer any questions. Nice to see you. There's Tony. Tony's there, channel. Hi, Tony. And Zhang Zhongjiang says, you got this. Okay. Remember to ask any questions if you have any questions as I go through the discussion about the strategy. Now, I want to go from talking about the strategy to talking a little bit more about my ideas about what's going to happen in the future as far as markets are concerned. So let's look at that in a little bit more detail. First, let's talk about equity. We can see oil price has been rebounding. That's the green line right here. Whoops, I got to grab my pen. So the green line has been rebounding recently, and then inflation has been coming down. But pretty much every time that the green line accelerates, it causes an acceleration in inflation across the world. And so I would say that we could be seeing inflation firing up. Now, my expectations right now is that we're going into a recession, and therefore what you're going to see is actually interest rates falling and inflation falling and continuing to fall. Now, if oil prices really shoot up, then we could be in trouble. Now, the volatility of energy prices is a reason that central banks look at core inflation measures that exclude food and energy. Though, if the oil price continues to rise, it could reaccelerate inflation as it's a key input for many industries. Now, the 3-month government bond yield has risen to 5% from almost half of that a year ago. Central banks battle inflation while trying to avoid severe recession or a banking crisis. Rates have come up quickly and inflation has come down, so we expect pauses or slower hikes from central banks. Now, after the 0.25 percentage point hike in July, the market expects a pause in September. We can see Fed Chair Powell's statement at the July meeting indicates that an uptick in inflation would be required for further rate hikes. The market is pricing in an 85% probability for a pause, meaning no more interest rate rises from the Fed. Now, yield curve inversion just has continued to be very negative signal for the world economy and for the U.S. All recessions in the U.S. since 1968 were preceded by an inverted yield curve. The average time from inversion until the recession started was about a year, which means fourth quarter of this year, we should be in recession. A low unemployment rate, as you can see, that red line is very low. It puts pressure on wages. In fact, the Fed needs to fight inflation, and that means that they're going to eventually be increasing unemployment as they try to slow down the economy. When unemployment has been this low, a recession has followed. So this is where I would say there's some signal here that we could be going into a recession, because every time we hit a low, recession. Every time we hit a low, recession. Every time we hit a low, recession. And that's the point I'm trying to make, is that we hit a low right here, and I think that it's very possible that we're going into a recession. Now, the expected yield Treasury yield curve has shifted up after the May FOMC meeting. The market thinks the rates will peak in fourth quarter 2023. The only thing the Fed seems willing to sacrifice in its battle against inflation are jobs. Now here, the Bank of England is expected, to be more aggressive to fight inflation. We can see that the Bank of England's market implied target rate is getting higher and higher. This is because, unlike the Fed and the US that has the power and the fiat currency, the Bank of England doesn't have that. If things go out of control with their currency, it could be a disaster. And that's one of the reasons why you're seeing their target rates and what they're expecting, which is to raise rates, right? So also valuations have risen as prices rebounded year to date. World stock valuations is now above the long-term average. That average is about 15 times roughly PE. And right now we're just about hitting 17 times. So the market's not that cheap, but I can also say that it's mainly the big cap tech companies that are the big part of this rise in valuation. The consensus net margin has come down a bit, and analysts have revised it down again recently. That's the blue line. So I like to look at the longer term trend. We can see the blue line rising like that. As profitability was rising, then the PE started to rise. And when profitability falls, the PE falls. But here we can see that as profitability basically has been steadily rising, we get a peak in PE. And so now that it's coming back down, and I think has a potential to come down a lot, then eventually we'll see that PEs coming down. There hasn't been much QT in Japan. We can see the ECB has been lowering. The Fed has lowered its balance sheet a little bit, and Japan has kind of been flat for nearly a year. Mainly central banks have let bonds mature, which has led to little change in their balance sheets. Central banks reducing their balance sheets means reduced liquidity. Now, for the past year, we've said that we think the course will be reversed. So I still think that central bankers and politicians will change course and lower interest rates and return to these accommodative policies as soon as possible or as soon as something breaks. And I do think that something's going to break. Now, let's look at the EU and Japan, which trade at a discount to the US. Before we do that, I'm going to go back to the slide and let's see. Hold on. It's good. We're getting some questions. I see JJ, ABB, and also Narit. Good to see you. I'm going to get to your questions. The first one is JJ says, in the long run, is the index fund perform better? Generally, an index fund that's a low-cost index fund will perform very, very well because you're not getting in and out of it. If you just buy and hold, you're going to get a great return. The problem we face in Thailand is that there's not a ton of index funds, number one. And number two, we want to kind of mix and match those a bit, right? And so that's where sometimes we may have an active, sometimes we may have a passive index. So if we can't, then we use an active one. Narit is asking about second, ABB says, hi, John Andrew, World War 2.5, is it over yet? EU will survive and come back strong. So the answer to that is that World War 2.5 is done. America has taken control of Europe. And now it can do whatever it wants in Europe to further its goals of going after China. So EU will eventually survive. It's just that, they're getting pushed around very hard by the US. Now, I'm going to come back to the other questions in just a second. So let's continue on with the presentation, and then that may answer some questions as we go through it. So here we can see EU and Japan are trading, their stock markets are trading at a discount to the US. So both the green and the blue line are deeply below the US. That wasn't always the case. If we look at the US in the past, we can see that these kind of follow the same pattern, but the US really broke out over the last 5 years or so. Now, EU has entered recession. Sticky inflation and interest rate differential to the US could lead to further ECB hikes in interest rate, though the statement accompanying the 0.5 or 25 basis points hike in July seems open to a pause. EU companies are resilient. They're used to operating a sluggish growth environment, and being a global leader in industrial automation, the EU could benefit from reshoring back to the EU. EU stands firm to benefit from firms. EU companies are to benefit from Chinese stimulus, as it's a major trading partner, as we can see right here. So we have a 25% target allocation to develop Europe equity in all-weather strategy. Now, here we can see that the Japanese companies have been hoarding cash. So the cash holdings is in trillion, and that's the red bar. And we can see that it's a massive amount of money right there. And then we have the blue line, which is that money as a percent of total GDP. Now Japan is sitting on, Japanese companies are sitting on $2.2 trillion in cash, an equivalent to 44% of their GDP. Now, high inflation in Japan means the private sector is pushed to spend and invest. High inflation can lead to private investments and higher consumer spending, not to lose purchasing power. So the Bank of Japan is going to allow 10-year yields up to 1%. Previously, they were kept at 0.5. And after this surprise tweak, what now for Bank of Japan's central or yield curve control central? Let's talk about yield curve control. It means that the Bank of Japan, in this case, intervenes to keep the 10-year bond within a certain range. This idea was introduced to stimulate inflation and growth. And the Bank of Thailand has more flexibility to deal with inflation in case it overshoots. It's the West that's dealing with inflation. Now, the Bank of Japan's surprise decision doesn't change our near-term view on Japanese stocks. The said reason for allowing 10-year yields up to 1% is to keep the yen more stable. A more stable yen should benefit Japanese companies and encourage foreign investment in Japanese companies. And one potential risk is that investors see this as the beginning of monetary tightening. We are going to maintain our 25% target allocation to Japan in AWS. Now, small caps typically perform better in a recovery, and they've actually performed relatively worse. And this also tells you that maybe we've got a recession coming. Europe appears attractive, and smaller companies generally have better growth prospects and are more agile in capitalizing on new opportunities. We have a 3% allocation to Europe small cap in AWS. Now let's look at the healthcare sector for a moment. Demand for care and drugs is independent of economic conditions or controls. When your grandmother is sick on the floor, right, then you are going to spend whatever it takes to get her good health care, no matter what's happening in the economy. So medical procedures that were delayed due to COVID are now driving demand. And we have a 17% allocation to world healthcare in all-weather alpha focus. Here we can see the strong momentum in tech. Much of the year-to-date recovery in the US market and others has been driven by tech. That is, what's going on here. It's a huge tech push. Now, infrastructure is defensive. We have a target allocation of 17%, and befitting from government's green energy, energy security, and other infrastructure spending. Typically, predictable cash flows, and being able to push through cost increases from inflation. So precious metal miners can benefit from sustained higher prices. I think I'm going to go back to the question and answer, and I'll try to answer some of the questions. First, let me stop sharing, and then I'm going to go in to the questions. All right. Kunarit says, second quarter earnings in the U.S. is positive or negative, and what do you think in the next 3 quarters going in a decline? So right now, consensus estimates, just was looking at this, second quarter earnings for S&P 500 are estimated to have fallen 6.4% year over year. So they're expecting that. And I would say that right now, America is really difficult to call because the economy is growing pretty strong. I think you can also make an argument that the weakest companies have already been destroyed from the COVID time, so only the strongest companies survive. So overall, I would say that we're still in a place where earnings for the big companies probably still do well, but for the smaller companies, we've seen a tapering off of earnings. Narit says, or sorry, that wasn't Narit. Hold on, let's go to Narit. Okay, we got that one. We just did it. All right. So now Supernut. How about US bonds? Ka. And I invested in AWS in July. Is still okay and in EU and Japan. So first of all, I think it's very likely that we're going to see interest rates come down in the US, and therefore US government bonds should do well. But I also think that there's credit risk and some other issues related to US government bonds. But generally, you want to buy US government bonds when interest rates have peaked, and we're pretty close to that spot. Kunatip says, how about Vietnam and India? So far, Vietnam and India have not come back into my portfolios, which tells you that I don't see a great opportunity right now in India or in Vietnam. Now, Tucky says, I don't have Nikkei 225 index fund in portfolio. Should I buy it now or wait? Well, ultimately, no one can answer that question. And, you probably should be talking to your advisor. Remember, for everybody on here, I'm not your advisor. I am a strategist, and I bring the strategy to Phenomenal. And then they bring that to you. So I would say that it kind of depends, but I would focus on dollar cost averaging, putting in an equal amount every single month. ABB says, if U.S. recession by year end, how's the rest of the world, EU and Japan, will be like? It's going to be tough for everybody if the U.S. goes into recession. And I would also say that I also think that the Fed is going to inject money into the economy and in their banking system. I think that they're going to do that by cutting interest rates massively. So we may end up with interest rates at 1 or 2% by the end of the year. So ultimately, I would say that it can hit all companies for the recession in all countries. But remember, my objective is to build long-term wealth. It's not to try to go in and out and time the market. Okay, Wu says, after the rally of big tech, would small cap tech be the next destination, or will the sector location happen to the defensive sector instead? I think that the next move will be into defensive stocks as we start to see the market come down. And so that's what I would say, is that they may perform a little bit like the bigger tech companies, but ultimately they're going to be squeezed. Okay, we got that one. Keep asking those questions. I'm going to go back to the presentation. And hopefully now you can see Let's talk about bonds. They're typically a safe place to be. In recession, safer assets like government bonds typically have performed well. Though with high inflation, low yields could still lead to negative returns. So investing in bonds now is not a bad idea, but you just have to accept that there still is some inflation adjustment you have to make. So if you think you're going to get 5% on a US bond, you may say, well, I'm going to factor in 2% for inflation. Now, we generally don't allocate to bonds to speculate on the upside, but rather to use it to protect capital over time. Let's look at commodities. Energy prices have come way down, and now they're hovering around $100. And though the oil price raced up to about 80 in July 2023, Saudi Arabian and Russian cuts are feeding through, and this could keep supply tight. It's an important thing to understand is that ultimately a recession coming, which is what I expect, will normally bring down oil price. But if we see a reduction in supply from Saudi Arabia and Russia, then that keeps oil prices high, and that's for their benefit for sure. If demand is satisfied, there could be further upside in oil prices. Now, food prices have softened, but they rebounded slightly in July 2023. And if the trend continues, it would help to lower the inflation, the pace of inflation in the different countries. And then adverse weather conditions could push up prices again. Let's look at commodities. They have rebound, but I think it's too early to call. The global economic growth outlook remains uncertain, and the main upside in commodities would come from supply shock, adverse weather conditions, or significantly higher demand due to an improved growth outlook. But remember, commodities are never over the long term going to earn what you can earn in equity. Now, we keep a minimum of 5% allocation in all-weather strategy and no allocation to commodities in Alpha Focus and Inflation Guard. What about gold? Central banks have been loading up on gold. This is just the first half, so we can expect, if I was to draw on this, maybe it ends up after the second quarter comes in to be like that. The recession risk remains, so we keep a relatively high gold allocation in our strategies, and that serves as insurance in case of uncertainty. In general, gold products value in times of uncertainty and market downturns. Now let's look at the risks. Inflation, central banks, aggressive rate hikes, and QT could crash the markets. If inflation reaccelerates, we could miss out on rising commodity prices. Our high gold allocation could get hit by higher rates or improved marketing. Now, before we get to the Q&A, the next valuation masterclass starts. That's class number 11. It starts on September 4th. Our limited super early bird price is still available for you. And with Phenomena, you can save $100 extra if you do it there. Now you get an extra $100 off on any price point until August 25th. And this is how you do it. You use this coupon code, or if you don't like all those words, just grab that link and put that link into your browser. So it's Q&A time. I'm going to stop sharing and try to answer the questions that you guys have been asking. So let me do that. If you have any questions, make sure to ask them now. So what I would say is that the performance of our strategies have been okay, but they're not knocking it out of the park. But for me, that's okay because I'm okay with building wealth year by year because I know how much that grows. ABB says your view on Bill Ackman short long-term bond versus Buffett long short-term bond. What are they thinking? So to be short long-term bonds basically means you expect that long-term bonds are going to fall. What causes long-term bonds to fall is rising rates. So you can say that Bill Ackman, and I think you mean Ackman, but Bill Ackman is expecting that interest rates on long-term bonds are going to rise. And that's the reason why he's short. And that could be he thinks that economic growth is going to come back. It could be that his expectation on inflation is, high. But that gives you a picture. All right. Well, we've been for about 38 minutes, and I appreciate all your questions and the discussion. And if you have further questions about our strategy, just let myself know or one of the Phenomena advisors. I want to thank everybody for taking the time to come here tonight and listen to the performance update. I hope that you have a great week ahead. That's the key. For long term, is it worth to pay extra fee for hedging currency? No. KT, I would say no, because currencies are a zero-sum game. One's winning while another's losing. So generally, I would say no. Now, if you really want to hedge currency, then in Thailand, you want to own mutual funds, because mutual funds that are foreign investment funds generally are going to hedge the currency risk. And so that's where you want to go if you need that. Please conclude what you think will happen to S&P in Europe from now to the end of the year. That's really difficult. My expectation is that the economy is going to start falling, the market's going to start falling, and the Fed's going to step in and decide to reduce interest rates. And when the Fed reduces interest rates, I think the markets are going to fly. So I'd be very careful I don't want to have no exposure to the US, but this is what I think can potentially happen. All right. Well, I want to thank everybody for coming tonight and also for your questions. KT has another one. What level of US dollar Japanese yen that the Bank of Japan will take action same as last time? I don't have a specific target on that, so I can't say that I have a strong opinion on that. I think my biggest thing that I like about Japan is that they've got 2,500 or 3,000 companies that are pretty well run and not that expensive. And so the underlying strength of the Japanese stock market, I think, is pretty strong. All right. Thanks, everybody, for attending, and thanks for your questions. Hopefully, we answered some. I'm going to take the rest of the evening off to relax at home for a little bit and then go to sleep. This morning, I woke up at 1 a.m. It was crazy. I don't know why I woke up so early. Boonlert says, what is your view on China A shares in second half this year? I'm not particularly positive on China A shares because I think that there's a lot of geopolitical risks. So from a long-term perspective, I'm roughly negative on China A shares. But we could see some rally. I mean, the China A shares have been beaten down so badly that we could see some rally. But overall, I wouldn't be buying Chinese equity myself. Make sure I'm not your advisor, so make sure you make your own decisions on that or talk to the advisors at Phenomena. All right. I want to thank everybody for coming, and I appreciate your questions. I hope that you have a great evening ahead and have a great weekend coming up. Bye.